We wanted to talk to you today because we understand that people are not surprisingly concerned both by world events and what's been going on in the capital markets. I want to say, first of all, of course, how concerned and upset we are by what's going on in Ukraine and by the actions of Russia, which are really horrible, and we thought we were past all this. But really the question for us today is, what are we seeing in the markets and what can we expect from the markets for our clients? Sadly, we've had experience with wars before. The first Gulf War 30 years ago, the second Gulf War about 12 years later. And what we know is that initially markets react very negatively, as is not surprising that over time the drawdowns that we see during wars are largely recovered, often quite quickly. And in fact, we saw a remarkable turnaround in the markets yesterday, and we don't know what's going to happen in the future. But I think it's important to understand that drawdowns are part of capital markets. As I speak, the NASDAQ index of largely technology stocks is down about 20% since the start of the year. The S&P index, the largest companies in the United States, is down about 11%, and the Toronto Stock Exchange is down around 6%. These are not surprising numbers. We get a drawdown of 20% once every couple years. We get a drawdown of 10% about once a year on average. So we're not dismayed or at all surprised to see drawdowns of this extent. Although I must say it's no fun, and of course we all like to see the markets go up. That's much more fun. Of more concern is that a number of stocks have been extraordinarily hard hit by the drawdown. Shopify, once the most valuable company on the Canadian Stock Exchange, is down about 62%, and Facebook, which has changed its name to Meta, is down around 46% in spite of having good earnings. I think what we're seeing here is a combination of factors. COVID, of course, is not done. We're still in the grip of a global pandemic. Everybody's worried about inflation, and there's a certainty that central banks around the world are going to raise interest rates. How soon and how much is open to question, but there's no doubt that's going to happen. And when you put on top of this the war now in Eastern Europe, the invasion of Ukraine by Russia, it adds yet another layer of uncertainty and discomfort. If we were short-term investors, if we were concerned about what happens today or next week or this month, I suppose we would be a lot more upset by what's going on in the market. But as our clients know, and particularly the clients who've been with us for a long time, our time horizon extends far beyond this week or this month. We're in this for the long term. Our time horizon extends into years. And over years, the events that we're seeing today, no matter how dire, tend to fade into relative insignificance. The path of stock markets is, over time, always upwards. It's impossible to find a 10-year period, for example, in which stock markets are down, but it's easy to find a 10-day period in which they're down. So patience is the number one virtue that we counsel for all of our investors. And the second thing is, particularly in this kind of period, quality matters. During the run-up of stocks, particularly in the last 24 months, we've seen a number of very speculative companies without earnings, companies in new industries and with new technologies soar to unbelievable price levels, valuations in the billions of dollars, even though there are no earnings and in some cases rather scanty revenues. Not surprisingly, those companies have been very hard hit in the last 2 months. Companies like, for example, Beyond Meat, down 75%. Zoom Technologies, which I know all of you are familiar with, down around 75%. And Shopify, as I mentioned, down about 62%. We don't buy companies that don't have earnings. We don't buy companies without a track record of solid management, solid growth, and solid operations. Those kind of quality companies stand the test of time. They make money for our shareholders as we go by year. Let's always remember that what we're investing in are not stocks, but companies. We're owners of little bits of companies. How those companies do, how they perform, how strong their earnings are, will ultimately determine the values of our portfolios. As Warren Buffett famously said, in the short term, the stock market is a voting machine. Right now, it's voting against technology, it's voting against new companies, it's voting against uncertainty. But in the long run, the stock market is a weighing machine. It's an analysis machine. And as we analyze companies with strong earnings and solid management, we know that those values will persist and grow. And that's how we'll make money. It's easy to get emotional when we're losing money in the stock market. None of us like to see that. Our job as managers is to ensure that reason overrides emotion, that we calm ourselves down, remember why we're doing this and how we're doing this, that we have a very strong process tested over 30 years, that we have strong internal resources here to ensure that we invest in the high quality companies that make money for our investors over time. So my message today is one of reassurance. We're not selling into panic. We never do. We didn't do it in 2008 during the great real estate panic. We didn't do it 2 years ago during the start of the COVID epidemic. We have faith in the quality of the companies we own. We know that they're going to make money over time. So I know you're concerned. Many of you have seen the values of your portfolios drop rather shockingly in the first 2 months of the year. Please try and be calm, try and exercise patience, and above all, let your brain rule over your emotions. Let reason be your guide. Thanks very much. Bye-bye.